Hello everyone, let's look at a question on valuing companies based on the asset-based valuation. Now, with asset-based valuation, there are three methods. We can value the company at its carrying value, so the value that appears in the statement of financial position. Of course, this is not deemed to be a good valuation because carrying value is based on historical cost. So my friends doing financial accounting knows what I'm talking about here. Then we have net realizable value, which is more realistic. So basically what we're saying here is its market value. And then we have replacement costs. So I will talk about replacement costs in a separate lecture, but in this question, we will use net realizable value or market value. So let's have a read. It says the following is an abridged version of the statement of financial position of Grasmere Contractors Co., an unquoted company, as at 30th of April X6. Now, the key information here is that this company is unquoted. Why does this matter? Because if this company was quoted, then we would simply take the value, the number of shares rather, in this case 200,000 shares, and multiply by its market value on the stock exchange, and we will get a valuation of the company, as simple as that. But because this company is unquoted, then it puts us in kind of a pickle, but we will solve this dilemma shortly. So we have the company's statement of financial position, non-current assets at carrying value, so 450,000. We have net current assets, 100,000. We have ordinary shares, reserves, and we have 6% loan notes. What are we told? So loan notes are redeemable at a premium of 2%. We will look at that in a minute. Current market value of freehold property exceeds book value by 30,000. Now, how is this information helpful? Remember, we're looking at net realizable value, so we will have to adjust the value on the statement of financial position. All assets other than property are estimated to be realizable at their book value. We want to value an 80% holding of ordinary shares in this company, Grasmere. So if we're using the total assets minus total liabilities, then let's work it out in the order that it has been set. So we have non-current assets. I'm going to save myself some time. I'm going to narrow this down to NCA. The current value is 450,000, but remember, we are told that the current market value of freehold property exceeds its book value by 30,000. So the value here is not 450, but 450 plus 30,000. So 450,000 plus 30,000, 480,000. Then we have net current assets. Remember what we are told here, all assets other than property are estimated at their realizable value. So this book value here is deemed to be the realizable value. So let me call this net current assets so that there's no confusion. So net or net CA current assets, I'm referring to this section here. Net current assets would be 100,000. Let's have a small subtotal. So far, our total assets, so I'm going to sum these two figures, is 580,000. Then we have the loan notes of 100,000, remember, which we have to deduct. This is our only liability, so loan notes. Now we are told if we were to redeem these loan notes, they would be redeemable at 2% premium. There's the information here. So our loan note is currently 100,000. So 100,000 multiplied by 1.02, 102,000. Now, let's have the value by taking assets, total of assets minus liabilities. So 580,000 minus 102,000. So it gives us 478,000 for the value of the business. However, this is if we are valuing 100% of the shares. Now we want to value, what is it, 80% of the ordinary shares. How many shares do we currently hold in this business? So 200,000 at $1, so that's 200,000 shares. So another way of looking at it is 200,000 shares are valued at $478,000. What is 80%? So 80% of 200,000 shares. So that's 160,000 shares that we want to value. So all we do, some simple maths, we take 478,000, we divide by 200,000, and we multiply by 160,000 to get the 80% valuation. There you go. So our value is $382,400. Now there are some pros and cons of doing it this way, which we'll talk about in forthcoming lectures, but I hope you get the idea. This is a good starting point for valuing your business. See you in the next one.